So Bitcoin futures are gaining acceptance. You starting to see the volume for Bitcoin futures go up, and you see a lot more groups such as like Ledger X attempting to become full board participants in Bitcoin futures and Bitcoin commodities. But one commodity that is a huge part of the commodities market, which isn't spoken about often enough, I think, is Bitcoin swaps, right? And why those don't exist, because they're a hyper effective tool for hedging, which allows an individual to participate and take a long position in the commodity without actually owning the commodity. Whereas like with a future, you're owning the future delivery of a commodity, right? You may not own it, but you will own it at expiration unless you trade out of the position. Whereas a swap allows you to take the upside, right, of a commodity for a relatively small fee and participate in the appreciation if there is any. So how would they work, right? And there's multiple types of swaps. Okay, a Bitcoin swap would probably take or would have to take the commodity for interest form of swap, right? And in that case, you have the fixed pay receiver and you have the fixed pay payer, okay? And the fixed pay receiver in this case would be, for instance, the person owning one Bitcoin, right? And let's say one Bitcoin is at $1,000. The fixed pay payer would pay some interest based on that price of Bitcoin, that $1,000, typically LIBOR, right, the London Interbank Offer Rate, plus a spread. So LIBOR is roughly 1.6, something like that, plus 5. Let's say LIBOR's 10, okay, just for argument's sake, that's the spread. So what would happen in the swap transaction is the fixed rate payer would pay, on a 30-day swap contract, would pay effectively $100, and they would in turn receive from the fixed rate receiver, person receiving the $100, the right to the accumulation of price appreciation in that 30-day period. So, for instance, if Bitcoin again is at 1,000, and during that 30-day period, at the end of the 30-day period, Bitcoin's gone up to 2,000, the fixed rate payer, the person who has paid the interest of $100, would receive 1,000 back because they're entitled to receive the appreciation, the price appreciation. If Bitcoin goes down or Bitcoin doesn't move, the fixed rate payer receives nothing. But at all times, the owner of the Bitcoin, the fixed rate receiver, receives that $100 as a fee for effectively loaning, right, or selling the future right to receive the appreciation of their Bitcoin for that 30-day period or however long the swap goes. The swaps can be a variable periods of time. But economically and functionally, for Bitcoin, especially if Bitcoin is going to reach an institutional level, having a vibrant swap market is actually very significant, right? You see a lot of interest rate swaps, you see currency swaps, things of that nature. And I'm not talking about atomic swaps where, like Shapeshift and others, where you're trading Ethereum for Bitcoin, swapping Ethereum for Bitcoin. That's not what we're discussing here. This is a regulated financial product which has a significant impact on the broader futures and commodities markets because it's a hedge. It's an effective hedging tool. And for widespread adoption in the financial community and the high level financial community, not just sort of arbitrage traders and at home traders, not that there's anything wrong with that, but it's a significant piece that's missing. And we're relying on futures, and I think the developments in Bitcoin futures, especially with non-cash delivery, right, where the delivery at expiration of the Bitcoin is actually in Bitcoin as opposed to a cash delivery like you see now with the CBOT and CBOE contracts, is very significant, right? And it's a super product. One, it will come online hopefully soon to effectively hedge positions, large positions in Bitcoin. But a swap actually gives you greater protection because it allows you to hedge against downward appreciation or upward appreciation depending on what side you're on, right? So it's a significant development that I think needs to happen, and there's a lack of understanding as to how it would happen in the market, in my opinion, for whatever that's worth. But I think that's something that I know parties are looking at and looking at implementing. But mechanically, in order for the economy of Bitcoin to really take off and really see true liquidity, not the liquidity that we see now, which you think is liquid, but on par with traditional financial products, it's really not that liquid. That's why you see these wide swings, right? Because it's generally illiquid. You need implementation of swaps alongside a vibrant futures market to truly regulate the market at an institutional level, because those are the ones moving the market at the most. So you have questions regarding how Bitcoin swaps operate, how they work, be sure to hit me up, Adam at adamtracy.io. Happy to answer any questions that you have, as always, and I'll check you later.